introduced on 30th of April this year, and in it has many amendments that's supposed to fill in a budget of 4.82 trillion. Biggest yet. So in it, there's many amendments that we shall delve into. Some very interesting, others so. And for instance, one of the major ones is we are seeing KRA get into being a sole minister in the sense that they're going to court for things, they're going to legislate things that they've lost. Shall get more into that. And also, how much will your thrift eventually cost? Because there's a change on that as well. But not to get so much into it, I'll get into our panelist. On my right, we have Kevin. Kevin is our tax manager, and he shall be dealing with income tax. Then we have Ken. Ken is also tax manager, and also he shall be dealing with tax procedures, acts and amendments that have come within there. And we have James, the director, who shall be dealing with VAT and shall tell us more about what the changes of VAT are, how much refund you're going to get after how long, and then after your budgets have become deep. Thank you and welcome. Welcome, Kevin.
Right. Thank you. Thank you so much, Lena, and very much welcome to our participants. As Lena mentioned, in this year's Finance Bill 2026 presentation, as we always say, still a bill. Nothing has come into law as of yet, and in the next cycle of a few weeks, we have to go through what we call the public participation on the bill. The bill goes through Parliament, and ultimately, by the end of the month of June, we ought to have in place the Finance Act 2026, which will become effective. Many of the proposals become effective on 1st of July 2026, with a few notable proposals that will become changes to the Income Tax Act. The Income Tax Act is the main statute that covers taxation on corporate income tax, pay as you earn, capital gains tax, and any provisions on taxation in relation to withholding income taxes. So the presentation on income tax will cover those four broad areas. And maybe to start, I can say that to summarize the changes in the income tax as proposed by the Finance Bill 2026, we are seeing the changes geared towards, number one, broadening the tax base. Number two, the changes are aimed at sealing any revenue leakages. Number three, we are seeing a deliberate effort to bring to tax some hard-to-tax sectors of the economy that have largely been informal. Of course, this is very well guided by the provisions of the medium-term revenue strategy 2025 to 2027 and the national tax policy. And number four, in my summary of the changes to the Income Tax Act, is that we have seen a concerning trend, like Lena mentioned earlier on. We are seeing a concerning trend whereby where the KRA loses some cases in court, they are going to legislatively try and turn around those taxpayers' victories that have been made by the courts. And I think that I want to pick my presentation from that particular point, simply because the first two changes I will have been informed largely by changes that, or by cases that have been determined by the courts. To kick us off, there is a proposal, the Finance Bill 2026, to expand the definition of management and professional fees, to explicitly include interchange fees and merchant fees on card transactions. And to elaborate on this is that in December 2025, there was a ruling that was made at the Supreme Court of Kenya, one of the rare cases where we have had a tax case go all the way to the Supreme Court, in a notable case between Barclays Bank of Kenya and the Kenya Revenue Authority. where the Supreme Court ruled that interchange fees and merchant fees paid by banks on terminating card transactions are not management and professional fees, and therefore there is a deliberate proposal to now mention that those interchange fees and merchant fees on card transaction will be subject to withholding tax by virtue of them being management and professional fees. On the same footing, we are seeing a proposal to expand the definition of royalty. On one part, to include payments for digital payments on payment infrastructure, again on card transactions. So these are payments that are made by banks to major card infrastructure holders like Visa and MasterCard. They will be included as part of royalties and ultimately subject to withholding tax, as well as transactions involving software distribution. Maybe to dive a little bit into this, again, on this issue of payments on digital payments infrastructure, it was one of the issues in that Barclays Bank of Kenya case versus the Kenya Revenue Authority, again, where the Supreme Court ruled that those are not royalties, but payments just to access the payment infrastructure, and hence not subject to withholding tax. And in a quick rejoinder, we have seen the government put that explicitly into law that those are loyalty payments. The change on software distribution, this is not the first time. I think this might be the third or the fourth time we are seeing a proposal on software distribution being included as royalty payments. And again, we have seen several cases being ruled at the Tax Appeals Tribunal, the notable one being the 7Cs Technologies case, where the Tax Appeals Tribunal ruled that when you have a software distribution that does not involve exploitation of the intangible in that software, that does not amount to a royalty. And in line even with the OECD guidelines on income tax, those are deemed to be business transactions which are subject to income tax at the prevailing date. So again, this will have a far-reaching implication, because we are saying that now any transaction involving distribution of software will be deemed a royalty, and the royalty is subject to withholding tax at the prevailing rates, either the resident payments or non-resident payments. Moving forward, on the betting and gaming industry, I think it has become a norm that in every budget cycle we have to have a change that affects the betting and the gaming of the definition of winnings in favor of a definition of withdrawals, which covers any form of payouts made by the companies in the betting and gaming industry, including the amount staked, which is subject to withholding tax. Now, a complete reversal of that is that we have seen an introduction of definition of winnings, but in particular only covering the lotteries and prize winnings, where the amount of winning less the amount staked or waggered is what will be subject to withholding tax at the rate of 20%, and withdrawals, which include the amount staked or waggered, will continue attracting withholding tax, but at a lower rate of 5%. On tax exempt gratuity, remember last year again, through Finance Act 2025, there was the introduction of tax exempt status of gratuity. And in a quick succession to it, the Kenya Revenue Authority issued a public notice noting that the only gratuity that was exempt was gratuity and after 1st of July 2025. Now, in a bid now to again restrict whoever accessing that exempt status of the gratuity, the Finance Bill 2025 proposes that for you to qualify for the tax exempt gratuity, it must be gratuity earned for a period of employment of more than 3 years, and it will be limited to 31% of the employee's basic earnings. So we are seeing sort of a tightening in terms of whoever accesses the qualification to tax exempt gratuity. Last year, again through Finance Act 2025, there was the introduction of some exemptions on payments made by the national carrier, that is Kenya Airways, on certain payments that are not locally available, and they were exempt from withholding tax. We are seeing a repeal of that in this year's Finance Bill 2026, which again raises so many questions in terms of something that was supposed to be covered by the national tax policy in terms of certainty of tax policies. And we are seeing very deliberate changes being made in quick succession, which does not augur well in terms of certainty of tax policy in the country. On rental income tax, we are on non-resident property owners and align it or simplify it to the normal monthly residential income tax. So for non-resident property owners, they will now be able to register under the simplified framework for payment of rental income tax, same like we have for the residential rental income tax, at a rate which the bill conspicuously missed, but we expect that will be aligned to the residential rental income tax rate. But what we are seeing is that they will be able to register on a simplified framework and pay tax on their gross tax payable. On the same issue, we have seen a proposal in the finance bill to increase the monthly rental income tax or the monthly residential income tax rate from 7.5% to 10%. And it's quite noting that listening yesterday to the CS Treasury, he alluded to the effect that they will retain that at 7.5%, but a reading of the Finance Bill 2026 shows that there is a proposal to increase that from 7.5% to 10% of the gross net. Remember, monthly residential rental income tax is payable by persons who earn rents of between 288,000 to 15 million shillings in a year, and is payable currently at a gross rate of 7.5% without taking into consideration any expenses. On some tax exemptions or reduced or preferential tax rates that have been enjoyed by large-scale residential housing developers at the rate of 15%, the bill proposes to repeal that. So large-scale residential housing developers will be liable to tax at the normal rate of 30% on their taxable gains. On scrap metal industry, again, we are seeing changes to these almost on every budget cycle. Last year, through the Finance Act 2025, the tax on scrap metal was repealed. We are seeing a reintroduction of this at the rate of 1.5% of the gross transactional value. Maybe what has informed this is that this industry on scrap metal has remained largely informal, and we are seeing a deliberate effort by the government to tax that income at source. Remember, especially on movement someone withholds from you, you'll be liable to declare the gross amount and of course offset the tax against the withholding tax that was deducted at source. On dividends payable to ESC citizens, they have always enjoyed a lower rate of withholding tax at 5%. There is a proposal to repeal that. So any dividends payable to ESC citizens from a Kenyan company, if the proposal goes into law, will be liable to tax at the normal and resident rate, or with dividends at 15%, unless where if you have a double tax agreement in place. The next change is really not a proposal, but a change that became law effective yesterday, because the president signed into law the Income Tax Amendment Act of 2026. And the change to it is that any transfer of property from a company to its shareholders that is necessitated by an internal group restructuring, number one, will not be deemed to be a dividend, in line with the provisions of Section 7. And number two, will be exempted from capital gains tax, as long as you're able to demonstrate that that transfer has been necessitated by an internal group restructuring. And also notable is that one of the issues that has always been contentious is what really is an internal group restructuring. The Income Tax Amendments Act of 2026 has provided a definition of what qualifies to be an internal restructuring for companies. So this is one of the only change that we are looking at that is already law. The rest of the changes will become law at the earliest of 1st of July 2026, once the Finance Act is assented into law. Continuing on the proposed changes to the Income Tax Act is that last year, again, the Finance Act 2025 provided that any payments to an unlisted ship owner will be liable to withholding tax at a rate of 2.5% of the gross value. Those payments were being taxed on a self-assessment scheme that now from 2025 they became subject to withholding tax at the rate of 2.5%. Now, to align the regime of withholding 5 days of either the payment being made on the ship leaving the port of Delhi. So again, we are seeing a deliberate effort on this one, that the government wants to collect withholding taxes at the very instant when that amount is either accrued or paid without any further delays. On trust income, we have been seeing some changes on and off during the last few budget cycles. And on this year's budget cycle, or the Finance Bill 2026, there is a proposal to simplify the taxation of trusts, and more or less to encourage trusts as a form of succession planning. So the proposed change to through the Finance Bill 2026 is that the income of a trust will now be taxed on the either the trustee or the executor or the administrator of that trust, with an exemption of any dividend or interest income will not be subjected to tax. And where there is a distribution from the trustee, the executor or the administrator to the beneficiaries of the trust, those amounts will not be subjected to any further tax. So to more or less simplifies the taxation of trust income and making trusts sort of become a bit lean in terms of their taxation, and avoiding several layers of taxation on that for the trusts. On pension payouts, through the medium-term revenue strategy and the national tax policy, there was deliberate action to make pension contributions come to what we call exempt status. So 3 exempt statuses. So the first exemption is that at the point of contribution, those contributions are exempt from tax. The income of the pension scheme is exempt from tax, and at payout, those payouts are also exempt from tax. So in a bid to align that, is that Finance Bill 2026 proposes that in the event those payouts are made as a result of the demise of a person to the beneficiaries who were identified, those pension payouts will again be exempt from tax. On investment allowance, in addition to industrial buildings, just a small clarity, the finance bill proposes that to align with the other investment allowances to be at the rate of on non-deposit taking financial institution, they have been having challenges in that the law provided that for them to enjoy the exemption from interest restriction provisions, they ought to undertake both the business of lending and leasing. So, in a bid to simplify that, the bill proposes that you need to be undertaking either of the two businesses, either you are in the business of lending or in the business of leasing, or both, but you don't have to undertake both at the same time to enjoy that exemption from interest restriction. There is a proposal to align the definition of country by country reporting in relation to an ultimate parent entity, to align it with what is provided under OECD guidelines. Remember, this is one of the changes that have been introduced since 2021 to align Kenya with the provisions of what we call BEPS Action 13 on country by country reporting requirements. Remember, where you have you are part of a group that is has a consolidated turnover of 95 million shillings, you are required to file your country by country reporting in that three-tiered approach where you file the local file, the master file, and the country by country report in alignment with the dates that are on the financial year end of the group. Now, we have a very consequential change on a proposal in terms of non-distribution of dividends. Currently, Section 24 of the Income Tax Act empowers the Commissioner to deem a distribution of dividends where the taxpayer has not distributed dividends, and the Commissioner is of the opinion that that non-distribution is aimed at avoiding a tax liability in terms of the withholding tax, and of also taking into consideration the business considerations or the financing requirements of the business. So that threshold of how much you need to distribute has always been at the discretion of the Commissioner. But we are seeing maybe a sort of a tightening of this, that distribution will be pegged at 60%, at least 60%. So the keyword is that it's at least 60%, which can be higher, of the distributable reserve. So for companies that are not distributing dividends, I think this is one area on that. It's one easy target that KRA has been able to target taxpayers. So we need to take a clear note of that. Of your distributable reserves. There are some changes to the income tax filing timelines, very consequential again, because the Finance Bill 2026 proposes that in the event of a nil return, that nil return ought to be filed within 1 month after year end. So especially for individuals, that would be filed by the end of January, and companies that would be filed by within 1 month of year end. And for other taxes or other tax returns, there's a proposal that timeline be reduced from 6 months after year end to 4 months after year end. Again, the reason why this becomes very consequential is that it will place a lot of onerous burden on taxpayers that they ought to have prepared, audited, and filed their tax returns within 4 months after year end. Again, we were deliberating around this, and we are not understanding what the urgency is, because in any event, the balance of tax is always payable within the 4 months after year end. So just a filing requirement. But again, listening to the CS Treasury yesterday, I think this is one of the proposals the government is not intending to take a reverse gear. They are really focused on implementing this. On capital gains tax on indirect transfers, we are seeing a concerted effort by the government to ensure that any offshore transactions that derive value from transactions or from immovable property or shares that are in Kenya of at least 20% are subjected to capital gains tax. This was earlier on introduced through Finance Act 2023, and the change through the Finance Bill 2026 is to try and ensure that all avenues that entail transfer of property and where that property derives its value from underlying shares of assets that are located in Kenya will be subjected to capital gains tax here in Kenya. There is a proposal to exempt capital gains tax on transfers to real estate investment trusts, on any property transferred to real estate investment trusts. I think this also coupled with stamp duty exemption proposal to try and encourage uptake of real estate investment trusts. Still on immovable property in relation to persons engaging in the business of extractive and mining industry, to provide that even if you transfer mining rights or exploration rights without a transfer of land, either of it will be subjected to capital gains tax. The current wording of the Income Tax Act provides that you have to transfer both the land and the mining rights, but I think what has happened is that people are transferring mining rights without a transfer of land, and either of which now will be subjected to capital gains tax. On branches, there is a deliberate effort to harmonize the taxation of branches with normal subsidiary companies at the rate of 30% and introduction of the branch repatriation tax. When this was introduced through Finance Act 2023, it didn't cover branch or other PEs in the extractive industry, so there's a proposal to expand that to the extractive industry. So in a nutshell, those are the proposed changes to the Income Tax Act. We continue through the cycle of the Finance Bill, and we will see what changes will become into law in the next few weeks. I wish to invite my colleague Kenneth to take us through the changes in the Tax Procedures Act. Kenneth?
Thank you very much, Kevin. Yes, good morning, everybody, and thank you for joining us. Today, I'll be taking us through the tax changes that are proposed to the Tax Procedures Act. And just similar to how you've seen the Income Tax Act, we can see that the government has really focused on the Tax Procedures Act in terms of trying to empower the commissioner in terms of the sources of information that he can get, and to the extent that he can automatically issue an assessment based on information that is received out there. So I'll start us off with the expansion of Section 3 of the Tax Procedures Act. And this basically introduces the definition of virtual assets and the virtual asset service provider. And this is following the enactment of the Virtual Asset Service Providers Act of 2025, which came into law on 15th October 2025. And basically this tries to cover the regulation around virtual assets. So we're talking about crypto assets, the Bitcoin and the rest, yeah. And basically what the as transactions that are enacted in relation to virtual assets, yeah. So for example, as the Capital Markets Authority and the Central Bank of Kenya are the ones who are in charge of regulating the virtual assets. So the Tax Procedures Act is also introducing a filing requirement for all these virtual asset service providers, so that the commissioner can also have an overview of what is happening in terms of the virtual assets. And we will capture how this information will be used for the commissioner to actually raise assessments based. So if they are able to find that you have transactions, you have some crypto somewhere stored of 1,000,000 shillings, the commissioner can actually use that information to raise an assessment based on that information. Yeah, so on top of that, not only will players under the Virtual Asset Service Providers Act be required to find information, the commissioner will also have powers to enter into agreements with foreign governments for the automatic exchange of information on virtual assets. So this provision, you can see that the KRA is trying to get additional ways of getting information. So not only will it be limited to information that they get from the Virtual Assets Service Providers Act in Kenya, they can be able to get into an agreement with a foreign country and be able to get information on the virtual assets that are traded in another country. Yeah, so we can see that the issue of virtual assets, and I think this is owing to the fact that there have been a lot of transactions, crypto transactions increasing over the years, and the commissioner is just trying to have an overview on how we can be able to tax some of this income that is generated from virtual assets. The next thing was amendment under section 10, which basically empowers the commissioner to reinstate your PIN in the case that it had already been registered. So if you have a tax liability and your PIN had already been deregistered, then you can go ahead and apply to the commissioner for the registration of the PIN. And what the finance bill proposes is that the commissioner can issue you a PIN, the same PIN that you had prior to the deregistration. So these are additional powers that are being included in the Tax Procedures Act. The next amendment is the issue of assessments, and basically the commissioner is empowering himself to be able to raise assessments based on information. So for example, in the case of virtual assets, so when the virtual asset service provider submits data to the revenue authority, then they can actually use that information which the commissioner can be able to get this information. So examples of that include, withholding tax returns. So if somebody has withheld on you payment, on you providing a professional service, then that information can be used by the commissioner to issue you an assessment. Another thing is the employment, whatever that the employer deducts in terms of income tax for the employees, that can be used. Another interesting one is whistleblower reports under the KRA Act. The KRA can actually use that information that a whistleblower has brought to issue you an assessment. Other examples include where they have integrated data with your systems. So that information that they do get from integrating with your systems, then that also comes into the ambit of what the commissioner can use to assess you. Other things is information that they find during a KRA audit, information that they find during inspection of goods at your premises, and another provision they say is information that the commissioner can request that is under written law. Yeah, so if the commissioner can request for information from a different entity, then they can use that information to raise an assessment to. Yeah, so we see some of these powers sort of the commissioner, we're sort of moving away from a self-assessment to the point that the commissioner will also almost be telling you what assessments you have. I think we've been seeing issues of taxpayers receiving messages and be told that we've noticed that there's some income there that you need to declare. So the introduction to the finance bill actually empowers the commissioner to go full force in terms of trying to collect taxes using information that they receive. The next introduction under section 12 is an exemption for PIN requirement when it comes to non-resident opening accounts in an investment fund. This is actually a very welcome provision because there was a lot of bureaucracy in terms of non-residents trying to something as simple as opening a bank account. So this is actually a very welcome move in that the fact that investment banks can be able to go and source money from non-residents and they will not be required to apply for a PIN. The next point, and it's similar to what the removal under the Income Tax Act. So what happens is the Tax Procedures Act has introduced a provision where it was actually been moved from the Income Tax Act, and now it has been put in the Tax Procedures Act so that it can be applied broadly. And basically what the powers allow the commissioner is to issue a tax assessment and the tax avoidance scheme has actually been expanded to include a cause of action, a plan, an agreement, whether or not that agreement is even enforceable in law. So, for example, if you go and have breakfast with a client and you shake your hands on a proposal that is deemed to be a tax avoidance scheme, and they've gone ahead to say what the definition of a tax benefit is anything that reduces your tax liability, or it reduces your input VAT, or it makes your lab, in terms of the timing of the liability, it pushes it forward, or anything that makes maybe a taxable supply, a non-taxable supply become taxable, and other similar kind of arrangements in terms of you trying to get a benefit, and where the commissioner is of the opinion that the whole purpose of this scheme was to get a tax advantage from that, then they can go ahead and issue a tax assessment. And remember now they have access to a lot of data which they're going to use in terms of coming up with their tax assessments under this provision. Another welcome provision was the introduction of the tax amnesty. This is under section 37E of the Tax Procedures Act. And basically, this is a very welcome move. There was a similar provision that was covering the taxes up to the year 2024. And what happens is that this Tax Procedures Act has actually extended this to now taxes that are going to be all the way up to 31st December, year 2025. So it means that even if you missed the previous tax amnesty, this is a welcome opportunity for you to be able to take advantage. Maybe one thing we want to know is if this is going to be used to help with the cleanup of the old issues. So, for example, the legacy issues that have been a thorn in the flesh for a lot of taxpayers. So maybe with the introduction of the tax amnesty, this may give an opportunity for the commissioner to actually avoid the penalties and interest in relation to principal taxes that are paid for the year up to 31st December 2025. So the condition is that for the principal tax must have been paid by the 31st December 2026. And if at that point maybe you not have paid the entire amount, then it is going to be prorated based on the principal tax that you have paid at that point. So this is actually one of the welcome moves under the finance bill proposals. Another one which is unfortunate, this is actually a provision that was introduced through Finance Act 2025. If you're going to withhold tax, say for example on a professional fee, then what the Tax Procedures Act currently says, if the person you offered the service to has already declared that income and has paid the relevant taxes, then you're exempted from the liability to again account for the principal withholding tax. So a year down the line, we are seeing that the finance bill is proposing for 2026 to remove this exemption. And so this is one of the things that you bring in a provision in this year, and in the next year, we are seeing the provision being removed. So this is actually something not welcome because it basically amounts to double taxation if the same income has already been accounted for and the tax paid on that. The next provision is issues when it comes to agency notices. Yeah. So currently the commissioner is restricted from issuing an agency notice where a taxpayer has appealed this, maybe under the tax appeals tribunal or the High Court or the Court of Appeal. So now what the Finance Bill 2026 proposes to do is remove that restriction, which means that once the commissioner issues the objection decision, then basically from that point they can go and attach your accounts and be able to collect those taxes. Many of you would have heard the cabinet secretary yesterday speaking about this issue. I think this is an issue that they have tried introducing through very, very many finance bills. And the issue with this is that it seems that the commissioner wants to overstep their powers here because it is basically denying justice to the taxpayer. If I do not have an opportunity to appeal, is that they will come and collect the taxes, and upon winning the appeal is when now you get the refund for the tax. So it is a very, very unfair proposal, and we hope during this time of lobbying we'll be able to get rid of this provision that they have tried to introduce through very many bills, but at the point of the act, it always comes out. So we are hoping that the same thing happens in this specific year. Another thing is the removal of the requirements. So the Finance Act 2026 actually proposed that for any imports that come into the country, that you're required to have a certificate of origin. And what the certificate of origin basically is meant to show where the good is prepared. So it's based on the rules of origin rules, yeah. And basically what this was creating a very huge administrative burden on the revenue authority, to a point that this proposal was actually meant to get the certificates of origin. And at that point, they still realized that it may still be difficult to get all taxpayers to provide this documentation. And there were some further exemptions that at the point of importation, if you do not have the certificate of origin, then you could provide other alternative documentation. And so now when this requirement has been removed, it's actually a welcome move because it was one of those provisions that did not make sense because the only reason I would need a certificate of origin is if I am getting a benefit from that specific importation. So if a good is actually maybe exempt from import duty, if it comes from a specific region, then that is the only place. Say, for example, under the East Africa Community Management Act, if I import a good from Uganda, then I will need a certificate of origin so that for me, I can be able to claim the tax-free benefits under the ECMA, for example. So the removal of this requirement is just removing additional bureaucracy, which is a welcome move for taxpayers. The next proposal, which is the commissioner just trying to reduce the number of ways in which you can use your overpaid taxes. So basically, you could use overpaid taxes in prior periods to offset against future tax liabilities. And the second one that you could use was on import VAT. So if you are importing maybe an equipment and you had the overpaid taxes and that approval was there, then you could offset the overpaid taxes against import VAT. So now we see the Tax Procedures Act being amended to remove the fact that you can actually use overpaid taxes to offset against import VAT. So it just messes around with the timing cash flows for taxpayers because it means that you have to make payment for imports even though the KRA owes you money and has approved that. Another introduction is the introduction of e-filing for using the pre-populated returns. And this was what we mentioned earlier in terms of the various sources in which they could use to actually pre-populate your return. So the question we're wondering is, Kenya, we operate under a self-assessment regime. And so when it comes to a point that we call ourselves a self-assessment regime, but the commissioner is the one who's actually filling the information that is required for you to file your tax return. So we can see there is sort of a move away from letting taxpayers just freely apply what their tax liability should be and make that payment. So the commissioner is actually going to be able to pre-populate your return. The commissioner is also empowered to issue regulations on how these populated tax returns are going to be handled there. So what this means is that the commissioner basically is giving himself powers to be able to determine what kind of information they're going to use in the pre-populated returns and the manner in which you are going to file those tax returns. He has the powers to issue those regulations. Another very interesting introduction that we see is now again the revision of timelines for lodging objections and appeals. And by appeals, we mean appeals to the Tax Appeals Tribunal, to the High Court, and as well as to the Court of Appeal. Yeah, so the Tax Laws Amendment of 2024 actually introduced an exemption to say that in the calculation of the timelines for objections and appeals from the taxpayer perspective, Saturdays, Sundays, and public holidays were exempted from the calculation of the days. So if you had 30 days to object if you have 30 days to do your objection, then in the calculation of the 30 days, Saturday, Sunday, and public holidays would not be included. And now this revision basically means that we're going back to using calendar days in terms of timelines for lodging objections. So we can see from the Income Tax Act, they are reducing the time in which you are required to file your income tax return. And on the side of the Tax Procedures Act, they're reducing the timelines for you to actually handle the dispute. And so you can see that the Revenue Authority is really interested in collecting now, right now, and later on is when now we're going to handle disputes later. So this is something that we will have to look at and hope that the commissioner can revert back to the previous regulations, which gave at least the taxpayer sufficient time to be able to issue their response. Another thing is the introduction of minimum penalties for failure to comply with the ETIMS requirement. Yeah? And by this complying with the ETIMS requirement, we're talking about matters of integration. So if you're required to integrate with the KRA and you do not do it, or if you're required to issue an ETIMS invoice and you do not do it, or in instances where there is where you have not complied with the requirements as per the electronic tax invoice management system regulations, then there is a penalty of twice the tax due under that failure to comply. But now the Finance Bill 2026 proposes to introduce a minimum sort of for if it's a penalty in relation to an individual, then there is a minimum penalty of 10,000. Mentioned in his public address, that is the fact that the perception that penalties are the ones that cause compliance in terms of tax regulation. And so you can see that this is what they're introducing in terms of trying to make people comply with the ETIMS requirements. Another very punitive introduction is limiting the commissioner's powers to waive penalties and interest relating to errors in electronic tax systems of up to 2 million Kenya shillings. So what happened is the Finance Act 2025 introduced the powers of the commissioner to waive penalties and interest, and it comes to whenever the errors are related to the electronic tax system. So for example, if there is a delay in transmission, or maybe there are two penalties, or the interest is wrong in the system, then these powers will actually grant the commissioner the right to be able to make a change within the system so that they will correct that misunderstanding. Or if they've given you maybe a tax obligation that was not actually meant to be yours. So the thing is now they have introduced a limit that he can only waive penalties and interest of any errors that are up to 2 million shillings. So we leave ourselves asking what happens to an error that is genuine, that was created by the electronic tax system, but the value is 10 million shillings. So the commissioner does not have powers to be able to waive penalties and interest. And these are some of the provisions that we need to lobby very strongly, because ideally they should not be limited when it comes to an error. If you make an error, no matter the quantum of the error, then the just thing to do is just to reverse the error in its entirety. So that, in a nutshell, covers the changes that were under the Tax Procedures Act. I'll quickly just take us through the Miscellaneous Fees and Levies Act, as well as the Stamp Duty Act. The changes are actually not so many. So the first thing was the change in terms of the import declaration. So what happens is 20% of the amount that's collected by the government under the import declaration fee is required to be maintained under a fund under the Public Management Act. And the purpose of this fund is basically to assist the Revenue Authority in terms of revenue mobilization activities. Yeah. So we see that in one end that they are reducing the amount that goes to this fund from 20% to 10%. So it means that less money under the IDF will actually be provided into the one end. You're trying to use technology and other types of getting information from third parties to be able to get information. But on the other end, whatever money that you collect, you do not want to allocate it in terms of trying to streamline or make your revenue raising measures better. The second thing is the change to the East Africa Community Partner States. So currently, the East Africa Community Partner States actually include Rwanda and Burundi. And now what happens is that they've actually changed this definition to say that now it is going to be the countries Kenya, Uganda, and Tanzania, and any other country that is going to join the East Africa Community Management in terms of the ECMA, the body itself. So it's opening that anybody else can be able to join the East Africa Community Partner States. But for now, it is the three countries of Kenya, Uganda, Tanzania that are included in the miscellaneous levies act. The third one we've seen is the restriction of IDF and RDL on aircraft. So previously, what used to happen, all goods and parts of Chapter 88, all those were not subject to IDF and RDL. And now what's happening is that we are seeing them trying to restrict this down to be on all parts of Chapter 88. And now the second part is only on aircraft of laden of 2,000 kilograms and above, the 15,000 kilograms and above. So we're looking at your big commercial airlines that will continue to enjoy this benefit. The other aircraft, the ones that are below 2,000, will continue to pay IDF and RDL. Another thing we've seen is IDF and RDL being removed from telephones. Similarly to this, we had what the Cabinet Secretary spoke in his presentation, and the whole idea was they were streamlining the issues of the taxes on telephones, and they were changing the system from it being various elements, the IDF, the RDL, and now only one tax is going to apply, which James is going to cover in subsequent sections, that is excise duty. Another welcome provision is the change in the Stamp Duty Act. So this would allow for the exemption of transfers to real estate investment trusts. And I think this is just in line with how the government has been trying to beef up real estate investment trusts in Kenya. So
Kenneth for that detailed explanation, as well as Kevin. And before we embark on the VAT proposed changes, I think one theme has been resounding. And the question is, are we moving from a self-assessment regime to a regime where the KRA actually determines how much tax you have to pay? And the reason I'm giving that sort of introduction is I believe from a VAT perspective, there was already a transition to the pre-population of returns. We've actually seen Ken mention that they're also trying to legislate this. Now, in addition to that, and maybe not necessarily to digress from the VAT discourse, Kevin alluded to the proposal to change the timelines for filing of the income tax returns. And if you actually look at the amendment that has been made, you will note that the very wording of section 52 is proposed to be changed and to do away with the word self-assessment. So you can actually see this issue of tax filings will become a major one, but I think from a VAT perspective, That has already been achieved with the pre-population that started towards the end of 2024. Though there are many challenges that taxpayers, I believe, have encountered where there are so many errors when it comes to transmission, where there is misclassification of the various supplies. You find something, instead of sitting in the zero rated schedule or worksheet, it's sitting in exempt. So there are those errors that persist. And I think this VAT issue of transmission errors has been a key one. And Ken has mentioned, it's unfortunate that they're proposing to limit such penalties out of system errors to only 2 million. You can imagine a taxpayer who has transmitted some sales invoices and the amounts end up being almost 100 times. Is that really the taxpayer's problem? The answer definitely is a no. And it's quite unfortunate that they are seeking to actually limit the amount the commissioner can waive as a result of any penalties arising from the electronic tax system. Now, when we get now to the VAT changes, I think the first amendment is basically just an alignment. There's actually a proposal to delete certain definitions pertaining to assessment, information technology, and tax computerized system. And this is just purely to align with the definitions that are already there. There is the issue of the applicability of VAT on any financial charge that is under a hire purchase agreement. So the current wording simply says that, look, if it's a hire purchase agreement, any financial charge is not considered to be considered to be a taxable supply. But what the proposal in the bill seeks to achieve is that for any such person who alleges that they are under a hire purchase agreement, then they must be licensed as such. So the issue of licensing with anyone who is doing hire purchase is very critical for the financial charge that is applied on the supply not to be subject to VAT. The third point, a very important and a very interesting proposal, is basically on a proposal to claw back any input VAT that a taxpayer could have claimed. And it so happens that the VAT status of the supplies has changed from being taxable to exempt. And at that particular point, when that change in the VAT status happens, you still held those goods basically in stock. So basically, the proposal is such that any input VAT that you had incurred, and there is that change in the VAT status from those items being taxable to VAT exempt, you have the KRA or basically will have to claw back on any input VAT that is attributable to any goods or items that you had in stock. So I think that is a very notable change, because then depending on how much input VAT you had claimed, you could end up having a VAT liability as a result. Then another change that keeps moving from year to year is the issue of claiming VAT refunds as a result of bad debts. If you might recall, the Tax Laws Amendment Act of 2024 actually increased the time, actually reduced the time to 2 years. And when I say 2 years, I basically mean, 2 years from the time you made a supply, you are actually entitled to claim, to actually apply for a VAT refund if you are dealing with a case of bad debts. So within 2 years, as per the current provision, you can actually proceed. And so basically there are certain conditions that are set. The first one is the issue of the time that the finance bill is seeking to extend from 2 years from the date of supply to 3 years. Or the other condition is if the debtor has been put under statutory management or is under administration, whichever of the two conditions comes first, you are actually entitled to apply for a VAT refund within a period of 10 years. Now, the proposal in the finance bill seeks to extend that time from date of supply from 2 years to 3 years. So basically just to delay a bit the timeline within which a taxpayer can make an application for a refund as a result of bad debts. The finance bill also seeks to clarify that all businesses are mandated to issue tax invoices. So there has been this big misconception that it's only those who are dealing with taxable supplies and who are VAT registered that are required to issue tax invoices. The bill just seeks to clarify that all businesses, regardless of whether you are dealing with VAT exempt supplies, you're actually supposed to issue a tax invoice. And maybe just to extend the reasoning so that you can see the gravity of compliance with e-teams, you will note that if you are not e-teams registered at the moment, and you try to apply for a tax compliance certificate, that is actually one of the conditions where you are actually mandated to make sure that you are registered for e-teams before you can actually get your tax compliance certificate. Then there is just an alignment, just like Kevin and Ken have indicated with regards to tax avoidance. The tax avoidance provisions in the VAT Act have equally been repealed, and everything has been consolidated under the tax avoidance provisions in the Tax Procedures Act. When we move to the next slide, a further amendment to an amendment that came in through the Finance Act of 2025 with regards to supplies to official aid funded projects. In Finance Act 2025, any lubricants and petroleum products that were supplied to official aid funded projects were no longer exempt from VAT. Similarly, there's a proposal to add to that any VAT on spare parts for vehicles. So you can actually see they're looking at the whole raft of any inputs that would go towards motor vehicles. So whether it is lubricants, whether it is petroleum, there's now a proposal to actually Now, if we look at the second point on the left side of the screen, is basically a proposal to increase the duty-free allowance for travelers accompanying baggage from $300 to $2,000. So I think that is a welcome move for any passengers who are traveling into the country in terms of the amounts that ordinarily would be allowed duty-free. Then a very interesting proposal. Financial services in themselves are exempt from VAT, but there's actually a proposal to subject certain financial services to VAT, which obviously has an impact on what it will cost to carry out certain financial services. And the specific financial services that will be affected by introduction of VAT are services such as carriage of cash, restocking of automated teller machines, money transfers, payment processing, settlement, merchants acquiring gateway or aggregation services over software or a platform. So you can actually see there is a proposal that there are these particular financial services that will no longer be VAT exempt and will be subject to VAT. There's also a clarity on the tourism sector as to who a tour operator is and what in-house supplies entail. Remember, tour operator services are VAT exempt with an exception of in-house supplies. So what are these in-house supplies? So in essence, to be very clear, for you to be considered a tour operator, you have to be basically in the business of offering tour or safaris, but then you have to be licensed as such an operator by the competent authority that is responsible for regulating that, and basically that is the Tourism Regulatory Authority. So it is not as simple as tomorrow I decide to buy a tour van and I decide to start offering tours, services and offering safaris, and I automatically assume that my tour operator services will be VAT exempt. First, you have to be licensed. So the issue of licensing is key. But there is an aspect of in-house supplies that you're offering to your clients. And in-house supplies basically means any supplies that are made from a tour operator's own resources or are bought from a third party, but the tour operator materially alters so that the supply made is substantially different to that is purchased. And just to give you a good example, and this might be of interest to tour operators, we have tour operators who have their own sort of their own vans and also have their own accommodation facilities. Now, that is what in-house supplies means, because as part of the tour package, you'll be charging for the safari, and part of that cost to the customer will also entail any other supplies that you make to them. So if you don't have in-house supplies, a tour operator would ordinarily approach a hotel, and you see for that aspect of what is paid to the hotel is ordinarily vatable. So it is drawing a parallel and saying, look, if you're a tour operator and you're actually offering such in-house supplies, or even if you have gotten them from a third party and you have materially changed them or differentiated them such that they're different from what you have actually procured from the third party, then those parts would have to be subjected to VAT. Now, if we move on, as is the normal practice with any VAT amendments or VAT proposed amendments, is the issue of recategorization of supplies from either being subject to VAT at 16% to exempt or zero rated, or vice versa. And we'll just quickly go through some of those proposed amendments. And the first set of proposed amendments, we are looking at supplies that are proposed that are general rated for VAT purposes, that are proposed to be exempt for VAT. Now, even as we look at some of these proposals, you will notice the impact of exemption simply means that any input that has been incurred in the course of making those VAT exempt supplies is not deductible at all. And one of the items we are looking at dialyzers of tariff number 8421.29. Then we're also looking at the supply of goods and services for the direct and exclusive use in the implementation of infrastructure projects undertaken under a public-private partnership framework. So those are also are proposed to be exempt. And obviously the issue of then the claimability of any deductible or non-claimable input VAT then would have to be passed on as a cost. Then similarly, the supply of imported or locally purchased telephones for cellular networks and other wireless networks has also been proposed to be VAT exempt. So currently, any supply of imported phones is VATable as we speak. And also, for those businesses that are involved in the local assembly and manufacture of cellular phones, the current position is that these locally assembled cellular phones are actually zero rated for VAT. And I think the biggest challenge that the local assemblers of cellular phones have had is the issue of huge VAT refund backlogs, because all the inputs that are imported for their local assembly of phones are subject to VAT at the point of importation. So there has actually been a challenge with a lot of local assemblers of phones when it comes to VAT refunds, because of the never-ending VAT refund backlog issue. And this proposed amendment seems to be an attempt to deal with that issue of the VAT refunds, because now even for the locally assembled forms that are VAT exempt, it basically means the local assemblers of the forms cannot be able to claim the input VAT, and that will have to be passed on as a cost. Then any worn clothing and other worn articles of tariff heading 6309, other than importation, would also equally be exempt from the current basically taxable supply at the rate of 16%. When we move to the next slide, these are proposed amendments to move items from VAT exempt status to general rated status. And we are basically we are looking at all goods and parts thereof of Chapter 88. Chapter 88 is basically on aircraft and aircraft parts. So there's a proposal to move those from VAT exempt to general rated. We also have direction finding compasses, instruments, and appliances for aircraft, so linked to the first point. Then any taxable goods for direct and exclusive use in the construction of tourism facilities. Again, this is a proposal that comes in the bill, is obviously shot down. You can imagine the impact that would have to the tourism sector in terms of Kenya's competitiveness as we are potentially looking at maybe a similar trend by the time we get the Finance Act of 2026. Then goods that are imported or purchased locally for the direct and exclusive use in the construction of houses under an affordable housing scheme that are currently VAT exempt are proposed to be moved to basically 16%. And our hope is that this will not make them increase the affordable housing levy deductions to cater for this impact in terms of costing. Then the supply of denatured ethanol of tariff number 22007 is equally proposed to be subject to VAT at 16% from the current VAT exempt status. Then similar to the point that I mentioned on the negative proposal to the tourism sector, where taxable services for direct and exclusive use for the construction of tourism facilities, recreational parks for 50 acres or more, convention and conference facilities are proposed to be subject to VAT at the rate of 16% from the current VAT exempt status. Then there are those zero-rated supplies that are proposed to be VAT exempt. And what you will note in this slide is that there's a lot of emphasis on electric or e-mobility. You can see if you look at the points on the right of this of the screen, the supply of solar and lithium-ion batteries that are currently zero-rated are proposed to be VAT exempt. The supply of electric buses and also bioethanol vapor stoves, cooking appliances, and plate warmers for liquid fuel. Then the supply of locally purchased telephones for cellular networks. I think that's a point I'd covered earlier. If we move to the left of the slide, there are those other items that are currently zero-rated. We have inputs or raw materials supplied to pharmaceutical manufacturers in Kenya for manufacturing medicaments. There's a proposal to exempt them. You can imagine the impact that will come, but that might not have a huge impact because as well, the inputs have been will be exempt, so there won't be much of an impact in terms of the deductibility of input. Then we have inputs or raw materials for the manufacture of animal feeds. You can imagine what that impact might have to basically to the agricultural sector. And also related to the agricultural sector is the issue of exempting the transportation of sugarcane from farms. Remember, transportation incurs certain deductible. Then also equally the supply of motorcycles of tariff heading 8711.60 are proposed to be exempt from VAT. I'll just quickly move on to the excise duty proposals. Now, for the excise duty proposals, you will notice that the slides that are there are in tabular format because the proposals are sort of two-pronged in the sense that there is a proposal to amend the existing descriptions, which some have far-reaching effects, and also there is a proposal to amend excise duty rates. Now, for example, if we look at the very first item, you have the issue of imported cellular phones. The proposed description is to amend this to read telephones for cellular networks and other wireless networks under tariff heading 8517. The current excise duty rate on imported cellular phones is 10%. The proposal is to actually increase the excise duty rate to 25%. So the resounding aspect that we want you to pick is that for any person who is dealing with excisable products, it is very important for us to keep checking by the time the Finance Act comes out if there's been any amendment. And the reason I'm mentioning this, and I would like to emphasize, is if you look at, and this goes to something that Kevin alluded earlier, and we were also confused along the way, how many finance bills of 2026 do we have? There was a copy that came out on the 30th of April. Then there was the copy that was published on the 5th of May. And there are some amendments, there are a few amendments between the two copies. Now, one of the major amendments, and this is of keen interest to persons who are dealing with excisable products, is that under the definition of imports in the Excise Duty Act, there was an introduction, there was in the first draft of the finance bill, there was a proposal to introduce a proviso that would sort of exclude any imports from the EAC from being subject to excise duty. 5 days down the line, a published copy of the Finance Bill 2026 comes out, and that proviso has been deleted. And the reason I'm emphasizing that is I want to move to the next slide and just kindly take note of share a tax alert that will have similar tables with the proposed amendments in the description, as well as the proposed amendments on the excise duty rates. But the reason I'm mentioning that issue of the proviso that was there in the initial draft of the finance bill is because it had proposed to exempt any imports from EAC from excise duty. However, the second version of the Finance Bill 2026 has deleted that proviso. And if we move to the, I'll just skip this slide. On this slide, maybe I'll just touch maybe on one thing. For those who deal with articles of plastics of tariff heading 3923.30, another change that I think for the last 4 years comes in the bill, then it is amended. For the current wording, you will note that excise duty is only applicable on imported articles of plastic. So for local manufacturers of articles of plastic, I believe you are not charging any excise duty. Now, if you look at the proposed amendment in the wording, it reverts back to what we have seen over the last 4 years, and it basically reads articles of plastic of tariff heading 3923.30. So that basically means local manufacturers again are being brought back within basically the excise duty ambit. I don't know if by the time we get the Finance Act 2026, it will be a case of what has been happening over the last couple of years. Now, if we move to the next slide, I want to focus on. I think the first change is important because of it's an aspect touching on imported ceramic sinks, wash basin pedestals. Basically, we're looking at the furnishings for the houses. The proposal is actually to just change the base that is subject to excise duty from being 5% of the customs value, or Kenya shillings 50 per kg, to 5% of the excisable value, or 50 shillings per kg. You can imagine the rebasing to the excisable value as the base basically increases the excise duty base. Now, the reason I mentioned that issue of that proviso of excluding any imports from EAC is, look at item number 3, which talks of imported glass bottles, excluding imported glass bottles for packaging of pharmaceutical products. I'll just read of the countries within the East African community. Now, if you look at the proposed wording, it simply reads imported glass bottles, excluding imported glass bottles for packaging of pharmaceutical products. One notable thing that you will notice is missing in the proposed amendment to the description is the aspect of the EAC. So that basically means for any Kenyan importer of those items that have that description excluding country imported from any countries within the East African community, you are potentially looking at and having to account for excise duty on such imports. And actually, if you look at this next slide, all these items, if you look at the description of the item in the first column, and you look at the description of the item in the second column, there is actually an exclusion of originating from East African community partner states that meet the East African community rules of origin. So you can see that exclusion could have a very, very big impact. And that's why you'll actually note in this table, like I mentioned, the proposed amendments for excise duty are sort of two-pronged. Changes in the description that has a resounding effect if these items are coming from EAC, and there's also a proposal for some of the items to actually change the excise duty rates. And like on this table, you'll notice on the excise duty rates, there's actually no proposed change, but the resounding change is on the proposed description of the various items. So that again repeats itself in the next slide. You can actually see there's a long description that is provided, but then towards the end, if you look at the first column, those originating from East African community. But then if you look at the second column with the proposed description, they've actually done away with that East African community origination aspect, similar to this rule. And all these detailed descriptions will be contained in our alert, because then it is very critical. You'll notice for VAT changes and excise duty changes, you have to be very critical as to the description of the goods. For VAT, you have to be very critical of the items that are listed in the first schedule or the second schedule, because the first schedule will ordinarily tell you what is VAT exempt. The second schedule will tell you what is zero rated. But I think for excise duty, what is important is these proposed changes to the descriptions. And if you look, the theme is sort of resounding itself. I know that those people who deal with that paper, that is the last point. Similar wording and similar trend with regards to the EAC aspect. So I will not belabor going through each item, all these details, and if there are any further questions, I think those can be taken offline depending on the nature of excisable products that you deal with. So it's sort of a resounding theme. I think I've talked on the issue of imported craft paper or paperboard. So you can actually see for those people in the sector who deal with paper products, there is something that needs to be checked with regards to any imports that are coming from the EAC. I think glass is another resounding excisable product that has that impact and that will be impacted by the proposal of the EAC. For coal, there's no proposed change in the definition. Basically the rate is proposed to be doubled from 2.5% of the customs value to 5%. For those of us who are into luxury cars, there is something that is proposed to be introduced, basically antique, vintage, and classic vehicles. And these are simply vehicles that are more than 30 years from the date of initial registration to the date of purchase, and that have a value that is at least 10 million shillings, excluding their depreciation. So basically, any person who has an interest in importing such vehicles, just note that there is a proposal to introduce excise duty at the rate of 50% of the excisable value. For the gaming and betting industry, the proposal is similarly, I think it's keen to look at the wording. The provision, the first column actually addresses the way the provisions are currently worded. But if you look at what is in the second column, excise duty on betting and gaming shall be on the amount that is deposited for gambling purposes. I think Kevin had alluded to that fact in the Income Tax Act in terms of proposals to amend what the meaning of withdrawals is. There's actually a meaning that has been that is proposed to be introduced in the excise duty on what amount deposited means, and it's basically any amount that has been put in by the punters. So that you can actually see for the first two items, there is no proposed change in the rate, but there is a proposed change. Then Ken touched on the issue of basically the government wanting to have a lot of information on virtual assets. Similarly, there's actually a proposal not on the rate. There's already an existing excise duty rate on basically the supply of virtual assets, but then the wording here basically talks of excise duty on fees that are charged on virtual assets transactions by virtual asset service providers. So I think that's also an important point and sort of underscores or emphasizes the aspect of virtual assets that Ken took us through. So that brings us to the end of the proposed changes from a VAT as well as excise duty perspective. And at this juncture, I will hand it over back to Lena.
Thank you, James. Thank you, Kevin. I can see there's hands. If you have any question, please put it on the question box, on the comment box. We shall be able to answer. Now, getting to it, there's been a lot of changes which have affected us, which will affect us, and which we need to look into. And with that, we have some questions that have already come in. Now, first one was Kevin. Now, we're being told that the bill is proposing that we move from a 6-month filing period after the year end, we have 6 months to file. Now we have four months file. That's rather short time. And how would this happen, especially for companies that say have multinationals and they have group filing requirements that require some synergy? How does KRA or how will we get into this with everybody now?
Okay, good question, Lena. Indeed, it's a mixed bag of reactions in terms of that issue of filing of tax returns, because on one hand, even listening to the CS Treasury yesterday expounding on some of these far-reaching changes that have been proposed in the bill, he made one very critical statement that what they are trying to do is, by any chance, the balance of tax for entities that are tax paying is already due by the last day of the 4th month. So he made a statement to the effect that they are just aligning the payment with the filing of the return. So that's looking at it on the one hand, because that's how possibly the government is looking at it, that in any conducted an audit by the last day of the 4th month. Why wait until the last day of the 6th month to file the return, or else you already paid your taxes by the last day of the 4th month? On the other hand, it creates a lot of challenges to taxpayers in terms of aligning even their financial statements, their books, ensuring that the books are audited, and also looking at it even from our perspective as professional firms. It will create a lot of pressure in that within the last day of the 4th month, then audit will have to be completed, and taxpayers, even those who are not even taxpaying, because generally you'll notice that if you are in tax losses, there is no requirement for you to pay any taxes by the last day of the 4th month. So you tend to even defer your audit to the last 2 months after your year end. So I think it will create a lot of friction. But listening again to the CS Treasury yesterday talk, it seems to be one of those proposals that the government seems not ready to engage a reverse gear on to maybe what they are saying, to align payment with the filing.
Okay, that's interesting. The next one will be on the dividends that you say that 60% now will be mandatory distribution on the dividends. What happens if you don't have cash flows to ascertain this, to get to the 60%? How do we manage our cash flows, and is there a way out for companies without the cash flows to meet the 60% threshold?
Wow, interesting again. It's an interesting question. On that issue of dividend distribution, I'll take us back to Section 24 of the Income Tax Act. That's the section that empowers the commissioner to force a dividend distribution, where the commission determines that within a period of 12 months, the taxpayer has not distributed dividends. Now, there's a proviso in a way to that provision, to that statute, in that for the commissioner to force you to distribute, the commissioner should also take into consideration your business requirements. So in a very long time, we have had scenarios where, yes, during an audit, KRA comes and finds that you are not distributing dividends, and the first question they always ask you is, why are you not distributing dividends? If you're able to put in or to put forth a proper business case, commercial investment, then you are able to get out of that forced distribution. So the answer to that is that the requirement for the commissioner to take into consideration the business requirements, and of course, the business requirements will also cover, do you have the cash flows to pay those dividends? It's still in place, as much as the law tries to seal that loophole, to provide that if you are not distributing dividends, at least 60% of your distributable reserves will be distributed. The commissioner will still need to take into consideration the business requirements, which will take into effect some of those issues, like if you don't have that cash flow.
That's true. Yeah, so the commissioner will take into that to see if you have the cash flows for that.
Correct.
The next question goes to James. And this is for M-Pesa, would VAT be applicable on M-Pesa charges? Is there anything that the bill has touched on the same?
Yes, thank you, Lorna. Yes. So I would say potentially yes, because if you look at the financial services that are proposed to basically move from VAT exempt status to taxable status, you will note there is an aspect there that talks of money transfers. So M-Pesa is mobile money transfer. As to whether there will be any lobbying around this, and especially given the velocity and the amounts of transactions that are being done nowadays on M-Pesa and mobile money, for that matter, you can imagine the impact of an introduction of VAT at the rate of 16% on money transfers it would have as to the cost.
So that means then, for the 30 shillings for transfer, you should look at for more VAT on the sale.
Correct.
All right, the next one will still be on VAT, and this one will touches on the payroll, outsourcing. Since there was a case that was enrolled on TAT. Now, has the bill touched on the same, or what's your way forward on payroll outsourcing in regards to VAT?
Yeah, interesting one, Lena, because if you look at Section 13 of the VAT Act, which basically covers aspects on what is really the taxable value of a supply. Part of I think subsection 4 talks of disbursements shall be excluded from the taxable value, and disbursement and parcel of the supply, of the taxable supply that you're making to a customer. And that ruling you have highlighted, Lena, was quite an interesting one, because for payroll outsourcing, the transfer to the outsourced payroll provider will have two components. We'll actually have the fee for the person who is outsourcing the payroll service, and it will also have the component that pertains to the actual payroll. Is that payroll amount really part of the taxable supply by the outsourced payroll provider? The answer is definitely no, because then the outsourced payroll provider can be able to show, I'm only picking this money and I'm remitting it. It's money that belongs to someone else. In the context of that ruling, it also depends on if there will be an appeal that is lodged on the same and what the outcome of the appeal is. But obviously, for the time being, we're looking at an adverse situation where basically VAT is being subjected to the entire cost, including the reimbursement, which I would really call a reimbursement or a disbursement of the payroll amount. But unfortunately, the Finance Bill 2026 has not addressed that issue.
So in case someone has this issue of a payroll outsourcing, probably we want to come we look at it before there's an appeal and get some money from there. So the next question would go to you, Ken. Now, in the Tax Procedure Act, it exempts some transactions from its registration. Does this include MRI? If I'm paying MRI for rental, is this included?
Yes, so this is actually not captured in the Finance Bill 2026, but the answer will be no, it's not captured.
Yeah, so if private should pay that, then on the same, now another question, we know that the previous Finance Act, it capped the tax losses 5 years from initially it was perpetuity. Now, as this bill touched on the same or anything, or we're still expecting it to be capped 5 years.
Yeah, so the provisions of the Finance Bill 2026 have not been on tax losses, so the previous provisions are still continuing to apply for the 5 years.
Okay, thank you. James, we have another one. This one is expound on the VAT changes on the charging of affordable housing of VAT.
That are supplied for an affordable housing project are currently exempt from VAT. And the proposal in the Finance Bill is that any such goods that are being supplied to affordable housing projects will now be subject to VAT at the rate of 16%. Obviously, what then that means in terms of the costs of the affordable housing projects, it's anticipated that will go up, because currently whatever is being supplied without VAT at the rate of 16%. If that amount then has to be loaded, then it has to be a cost that is actually being borne by the persons who are involved in affordable housing projects.
Ken, you said something about overpayment and how what payments will work will forward. Are there funds will taxpayers get refunds in case you have done an overpayment, or how will the mechanisms of this work around?
Yeah, that's a very good question. And I think this has been one of the most important issues when it comes in terms of applying and getting your refunds. So we've seen that no matter what legislation is put up, so for example, there's a payment period, there's a period in which the commission is actually required to process your refund and pay you. And we've seen at the point at which the timeline ends, they're coming up and issuing other documents, they have a payment assessment, which has credit assessment, which has for VAT. And you find that now at the time of coming to apply that overpayment, you still need to go ahead and have verification done from the revenue authority perspective. So it's just a timeline that keeps moving, and they find smarter ways of going away from having to actually pay. You see now in the finance bill, they have said that you cannot even use the overpayment to offset against input VAT on something that you're importing. So you're saying they're actually they're not opening it up as much as the issue.
So, Kevin, in case someone wants to push back, how does the public have any public participation? How do we go around it if someone wants to push back on the sale?
Okay, thank you, Lena, on that. Latest, the day before yesterday, or rather yesterday, there was a publication in the newspapers opening forum to the public, professionals equally, to submit the submission of finance and planning by around 23rd of this month. And after that, the committee will invite people who have made submissions to go and present their submissions, and they're able to consider that. So the process is open to everyone, but at the same time, the speaker we usually present our submissions and present submissions received from our clients and be able to represent our clients on that forum with the National Assembly Committee on Finance and Planning, so that during that public participation process, which has become enshrined in any lawmaking process, the views of the public and anybody who is affected by these changes are taken into consideration. So, Speaker, we are happy to take up your considerations and submit them, but for those who may want to go ahead and submit their proposals directly, the forum is equally open to everyone.
Thank you for that. Now, and then the last one, there seems to be a moral agency trio. The Kenyan, there seems to be complaints every time about how they're going to pay our taxes, how there's a general below morale in paying taxes in the public. Speak to this, and also given that there's an amnesty that has been given, how can we as PKF assist with the amnesty process, and maybe this would improve the morale for paying taxes, and yes, the morale since that there's an amnesty and given the general feel in the public.
Yeah, thank you, Lorna. Quite an interesting question. My personal view is that I think Kenyans would have the morale to pay taxes if first the government supported businesses. I think that is the most basic thing. And you see, we sit in a position where we're able to look at financial statements for clients. We are able to see the strain with which businesses have to pay tax. It is there. It is a real strain because you get to installment taxes, pay as one returns are due, VAT returns, excise duty returns are due, and your client tells you, "Can I get an extension of time to pay? Can I pay in installments?" And that only speaks to cabinet secretary's statements was that they have noticed with a lot of concern that there is a huge reduction in the pay as you earn. And one of the things he alluded to, which does not form part of this Finance Bill 2026, and which we expected would be the issue of the review of the pay as you earn bonds. He alluded to it in his statements yesterday, that we should see something on pay as you earn. So that is something we need, most probably we will see when it comes. But I think generally the morale to pay taxes first is not a moral issue, is an issue with the reality that businesses are really struggling to pay these taxes. That's the first issue. Then the second issue on the moral aspect is it is quite unfortunate that this monster called corruption is a never-ending discussion. I think we see this daily in social media, in the press, and nothing seems to happen about it. And also, more importantly, is how the revenues that are collected by the government, whether it's in taxes, whether it's in appropriations in aid, how that money is used. You pass on the roads and the state of the roads is pathetic. It rains for 10 minutes and everything is clogged. And you'll notice that if you look at the more developed economies, in some of the jurisdictions, the tax rates are actually quite high, almost to the tune of almost 60%. But why is it that the citizens in those developed countries don't have an issue, don't have a moral issue when it comes to payment of tax? And the answer is very simple. It's because the government is giving them back. Yeah, it's giving them back in terms of proper infrastructure, it's giving them back in terms of subsidies or incentives on education, insurance, medical. Here you have to basically forfeit leave from your pocket. Whatever is your take home, or whatever businesses' profits are, you have to cater for everything. Earlier, towards the end of last year, earlier this year, I think for manufacturers and those people who have standards levy to pay, there was that spike from 400,000 shillings per year to 4 million shillings. So you can imagine the cost of doing business as well keeps increasing in very many aspects, whether it's business licenses, whether it's regulatory compliance related costs. But then there is nothing that, to be honest, as individuals, as citizens, and even as businesses, that we feel the government is actually giving back. At the end of concerted efforts by the government to expand and widen the tax net, introduce new taxes, try and basically seal any loopholes in provisions that are either ambiguous, that have resulted in tax leakages, dealing with tax exemptions that have sort of eroded the tax base. There is still an obligation that the government has with regards to, one, supporting the businesses in creating a conducive business environment. Looking at the issue of cost, I think that's an important one. For manufacturers, they have to contend with high costs of electricity. I think it is in the public domain how many manufacturers have left over the past couple of years because of a simple thing as huge costs of production, electricity being one of them. Yeah, so I think the morale really and the onus is on the government to make sure that it actually has something to give back to the Kenyans. I think that is the only way the morale will come. Obviously, the amnesties are welcome move because you can imagine the amount of savings taxpayers will make from the savings of penalties and interest. But then remember, it's also a very short window because assuming this proposal is enacted into law, taxpayers will literally basically have 6 months until end of December 2026 to pay. But I think it's better than nothing. But I don't think necessarily it's a moral boost. At the end of the day, businesses will still be required to pay tax, which they should have paid anyway. But I don't think that in itself is just a pure moral booster. It's a booster if the government cannot support businesses.
Thank you very much. Thank you so much, panelists, and thank you too for joining us. We are very grateful that you had your time to come and listen to us. This recording will be shared with you, and also we shall share with you a tax alert after we're done filing it. Till next time, see you.